Hi guys, how you doing? It's good to see you, even if it's through a camera. Definitely not the normal way I like to teach, but at least I get to stand up in front of this gorgeous backdrop here. So today I want to talk to you about the stock market, how stocks work, things of that nature. You guys were asking me a lot about this before we went on our extended hiatus here, and I wanted to explain kind of how that all works, but it definitely feels like something is missing. I got it. So let me tell you about the stock market. Stock market is basically this idea that you can buy a piece of a company and benefit as the company benefits, or not if the company doesn't. So basically the idea here is if you buy a piece of stock or you buy stock in a company, the value that you pay for it makes you money if then the company does well, the value of the stock goes up, and other people are willing to pay more than you paid for it. And your value of your stock goes down if you buy the stock at a certain price and then people aren't willing to pay that price. They're only willing to pay a lesser price for that stock. Now, people freak out a lot when the stock values go up and down, and they say that they're losing lots of money in the stock market when they buy it for, say, $100 a share and then it drops to $85 a share. They feel like they've lost $15 per share. That's not totally accurate. They have only lost money if they sell for $85. If they wait, it might recover and then they haven't lost any money. Conversely, people who buy a $100 share might see the value of that share go up to $122 and then they feel like they've made $22 a share. Again, the only way you make money in the stock market, though, is if you can get somebody to purchase your stock for more than you paid for it. So that's generally how the value works. Let me give you a little bit more overview of like where they came from and how they work and why people buy stock. In addition to just trading off of the values of a stock, people are also sharing the risk this way. One of the reasons a company wants to have people pay into their company and buy shares of their stock is they get an infusion of money that helps support them. All these people buying their stock help them use that money to pay for upgrades and better products and quality services and workers and all that kind of stuff. So that's why companies would even sell stock in the first place. Historically, the way stock was kind of invented in a lot of ways was from what was called joint stock companies, where people would actually pool their resources and share the risk of business ventures. So in particular, it started with shipping. So if I owned a ship and you owned a ship and we had a bunch of buddies who owned ships, if we all got together and said, hey, let's combine our resources, all our ships will be equally shared in terms of the value they produce. We send them off and sell some goods, and when they come back, we will share the profits of all of that. That's a safer bet than me just taking my ship, sending it off and saying, okay, I'm gonna go sell some products overseas, and then when I come back, I'll make money. Because if my ship doesn't make it, the crew mutinies, there's a hurricane and they sink, they're captured by pirates or anything like that, I've lost all of that value. But if all of us pool our resources and my ship goes down, but I'm in an agreement with all of you and we have joint stock in all of these companies, or all these ships, I should say, then our company will still gain some value even if my ship goes down and your ship goes down, our 8 other buddies or whatever, their ships make it back. We all share those profits. We've minimized our risk and we've maximized some profit. Now, we haven't gotten the most profit because we have to share it with other people, but if we had, like if I had done it by myself, I would have gotten all the profits, but now I have all the risk. So that's where it comes from. The modern day equivalent of that is what's called a mutual fund, where people will invest some of their money in a variety of stocks that are also co-owned by other people. And the idea there is you don't have to put in all of your finances to the stock, and they don't either. So you minimize some of your risk. Now, you don't make as much money doing that, but you can still make some money doing that. The analogy I also like to use is imagine a big plate glass window on like the front of a store or a bar. If this is a movie, somebody's gonna come crashing through that window in just a second. But if you imagine that big plate glass window and somebody throws a rock through that window, the whole glass just shatters and goes everywhere. You've lost your whole window. A mutual fund or a joint stock company is kind of like putting panes of glass in that window. So you've got these dividers and smaller panes of glass. Now, you can't see as well out the window. That's your profit. You're not going to make as much money But if somebody throws a rock through one of the panes, it's a lot easier to replace the small square than it is to replace the whole window. So that's a mutual fund. That's where joint stocks comes from. The other thing I want to talk about is day trading versus kind of long-term investments. So the stock market has taken a big hit lately with this whole coronavirus thing. A lot of people have lost a lot of money day trading in the stock market because it's crashed so hard. Day trading is where you're just constantly buying and selling stock at price values, either in the New York Stock Exchange or through a lot of the online media companies, online companies that do day trading kinds of things. People are also getting hurt on their long-term investments, like people's 401ks took a crash again because the stock market plunged so far. But again, only if they're drawing on their 401k does that really hurt them now. So for like me, I'm expecting to work for a couple decades still. I lost some money in my retirement plan. I have a 401k, and that lost a lot of value over the course of the last few weeks. But because I'm in a long-term investment strategy, my investments are less risky. And even though I lose money in the value right now, the goal is over the long term, the general trajectory will continue to go up. And so I won't lose money in the long term. Short term, people got dinged pretty hard in this stock market dip. Long term, less likely. As part of that long-term strategy as well, people like to use what is called diversification. They like to diversify their funds. Having all of your eggs in one basket is an old-fashioned analogy, but imagine that you had to go collect eggs and you were a farmer or something and you're picking up chickens and grabbing eggs and sticking them in the basket. If you are clumsy, like some of you probably are, and you trip and fall and all those eggs all over the ground, then you've lost all of your eggs. So diversifying, putting different eggs in different baskets and carrying them, again, it might be a little bit more work to keep track of multiple baskets and carry multiple baskets, but you won't trip and fall and lose all of your eggs. So it's kind of similar to the mutual fund idea, but you could do this individually too and just buy stocks in different areas, but that's the key to make sure that you have a robust, healthy, widespread investment plan. So that's kind of the basics of the stock market. If you have any questions, you're going to post them in the discussion section. If you have any comments, you should post them there as well. I'm also going to have you watch one other video that kind of explains the actual market exchange that is better done with animations and graphics than just looking at me talking at you. So thanks guys, I miss you. I hope you're doing well. Stay home, stay healthy.